Joining us now is Mark Zandi, chief economist at Moody's Analytics. Mark, I wonder, even if inflation seems to have been under control for the month of February, does this tariff turbulence freeze the Fed from cutting anytime soon?
It does. They told us point blank that the economic uncertainty, the policy uncertainty, the uncertainty around economic policy, I should say, is a reason not to move. They're not under a whole lot of pressure. Inflation's on the high side of their target, but pretty close. And growth is okay. The economy is still pretty close to full employment, so no real pressure to move. And given the uncertainty around economic policy, and of course we're seeing that on a daily, hourly basis, no reason to move quickly here. They want to gauge how this is all going to play out before they take another step.
So where are we most likely to see actionable information in the CPI report? How much of it maybe has to do with shelter and how that's trending? That's been an issue for consumers for quite a while. How much of it just has to do with falling within expectations? No huge surprises.
Yeah, I think, John, if it's the monthly increase is 0.3%, and that means the year-over-year growth is close to 3%. That's right down the strike zone. I mean, again, that's on the high side of what the Fed would like to see, but that's where market expectations are. I don't think any big moves. I mean, I think if you look under the hood and take a look at the different components, I think the thing to look at are things that matter to people, like what's going on with food prices, right? That was pretty hot last month. It's been pretty hot over the last several months. So we should watch that very carefully if it comes in with a strong increase. Energy prices matter a lot to people. And of course, the cost of housing and the cost of rent. So those are staples. Those are things that people need. And those are what people are focused on. And I think, those are the things that we might want to take a close look at, abstracting from what it means for monetary policy.
Mark, I mean, it's interesting because in 2022, we saw this aggressive, fast and furious tightening cycle on the monetary policy front. We continue, and yes, I realize we've seen a couple of cuts, but we continue to be in what many officials would call restrictive territory, where rates are concerned. And yet it looked like a soft landing was actually emerging. And I wonder if we need to be talking more about the role that fiscal policy played in that dynamic, especially now as you start to take that out of the equation and you see cuts to things like government spending.
Well, yeah, you make a great point. The economy was doing just fine with a pretty high federal funds rate target. The federal funds rate target's just under 4.5%. That's higher than I think any official or economist would say is the so-called equilibrium rate, that rate at which policies needed are supporting or restraining economic growth. My own view is, though, if we stay here for a long time, it will wear on the economy, and abstracting from everything else, tariffs, trade war, Doge, everything else, the economy would start to feel it. So we would have to see lower interest rates. But now you throw into the mix the very significant restraint on growth that's occurring because of the trade war, the developing trade war, and now the Doge cuts to government employment and to funding. It makes a greater case that perhaps the Fed is going to need to move more quickly in cutting interest rates. Of course, they have to have the eye on what the tariffs and immigration policy means for inflation at the same time. So it puts them in a pretty tough spot. But my guess is, in the not too distant future, the growth effects will outweigh the inflationary effects, and they'll start cutting interest rates again because they'll have to offset some of the restraint from the federal government. The other thing is, when the economy is slowing, and it's slowing, and the trade war is doing real damage, if you get into a real scrape, the federal government kind of steps in and tries to provide support. Some of it's automatic, in the tax code and spending. Some of it is discretionary. Lawmakers come together and say, hey, we got to give the economy some help. None of that's going to happen this go around because of the Doge cuts. So I think more of the onus on keeping the economy out of recession here is going to fall on the Fed. And that probably means lower rates than otherwise would be the case.